Hello, and thank you for joining us on our webinar series, 10 Questions with Reunion. My name is Billy Lee, and I'm the president and co-founder of Reunion, the leading marketplace for clean energy tax credits. We work with corporate finance teams to purchase tax credits from solar, wind, battery, and other clean energy projects. Today, we are joined by Marc Schultz, a partner at Snell and Wilmer, and a well-known tax attorney in the energy and federal tax credit space. Marc, welcome. And can you first tell us a little bit about yourself and your practice?
Well, thank you, Billy. I appreciate the invite to come along and speak to you. I am a tax credit finance attorney. I've been practicing since 1997. I live in Phoenix. I am the co-head of our renewable energy practice and the head of our tax credit financing practice at Snell and Wilmer. We've got, I think, 16 offices, our largest office being in Phoenix, our farthest east office being in Washington, D.C., and we have 3 California offices. I do mostly everything from private equity, real estate transactions, opportunity zone incentive transactions, and then quite a bit on the tax credit financing side, from low-income housing to new markets to historic tax credits. And as we're going to talk about the renewable energy tax credits, both ITCs and PTCs.
Great. Awesome. Thank you for joining us. So today we're talking about investing in renewable energy as an individual. And historically, that has been challenging. Unlike real estate, where many individuals, broadly speaking, participate in the direct ownership of rental real estate, for example, we haven't seen this type of broad investment into solar and wind and other renewables, despite becoming a very large asset class. One of the main barriers is the passive activity rules. Can you briefly explain what these rules are and what they're meant to achieve?
So the passive activity rules, and this applies to both credits and losses. So they're, you call them passive activity credit rules and passive activity loss rules. These rules were put in place in the 80s to curb an abuse that Congress thought was going on with respect to mostly individuals that were investing in assets that were highly levered, quickly depreciated, where folks were putting a little bit of cash in, but because of the leverage, they were using the tax losses to wipe out all of their income. So, for example, a physician may invest in a movie tax shelter. There are quite a few movies. I've seen the list of movies that we've all seen that were set up as tax shelters. And so they may invest in a movie tax shelter, end up with a bunch of losses, and then use those losses to wipe out their income from practicing medicine. So what Congress decided to do is impose both an at-risk rule, which we may touch on, as well as a passive activity loss rule. And those rules basically say if you're subject, not everyone is subject to these passive activity rules. I know we'll talk about that, but if you are subject to these rules and you're not a material participant in a trade or business, then those losses are passive, and you can only use those losses against your income from other passive activities. So that's in a nutshell what the passive loss rules are. And of course, the corollary to that are the credit rules. And so the same thing applies. If I have an activity that generates a credit and I'm not a material participant in that activity, then I can only use that credit against my tax liability from other passive activities.
Got it. Understood. So the Inflation Reduction Act included a provision that now allows a number of different credits to be bought and sold between unrelated parties. We call this transferability. This is what our business is kind of focused around. And over the past year, we've received a ton of inquiries from individuals who are eager to reduce their tax liability by buying renewable energy tax credits. What type of individual taxpayers, if any, should consider tax credit purchases?
Well, the Inflation Reduction Act, in the Inflation Reduction Act itself doesn't mention the application of the passive activity credit rules. But in the proposed regulations that recently were released by Treasury, it does say that the passive activity losses, the passive activity rules do apply to these credits for the folks that are subject to these rules. So some people were hoping, well, the word activity is really important here. So you have to have an activity in a trade or business. So some folks were hoping, well, if I just go and buy these credits, there's no real activity. I'm just using the credits against my tax liability. There's no activity here, so this shouldn't be considered subject to the Section 469 rules. And so what the regulation said is, no, we're going to deem it to be an activity. And so if you are subject to these rules, this is an activity subject to these rules. And so it means that if you're an individual and you go and buy these credits, you have to look at these credits, and you can only apply these credits to your tax liability from other activities that you invest in. So let's just say, Billy, I invest in your restaurant, and it is a fantastic restaurant. It's making lots of money. You give me a K1, it's an LLC, and you give me a K1 every year, and it's got taxable income on it that's being allocated to me, and I am not a material participant in your restaurant. That income would generate a tax liability for me, and I would be able to use those credits that I purchased from a solar project against that tax liability. So that would be your perfect example of a situation where an individual could take advantage of this. Now, there's also some rules that say you can't wipe out more than, I think it's 75% of your tax liability, but that's besides the point. I know that's not what we're talking about today, but there are some other limitations. But generally, if I'm an individual that gets that K1, that's trade or business income, I'm not a material participant, then I would be able to use those credits against that tax liability.
Got it. So said differently, I think what you're saying is only taxpayers with tax liability from passive income should really consider these tax credit purchases.
Correct.
Great. And then, we all know people who have done well selling businesses or selling stocks or just, having securities portfolios. What about income from dividends and capital gains? Is this passive income?
Well, there's a category called portfolio income. So think about it this way. On the loss and credit side, we've got passive and active. So we've got passive losses, passive credits. We've got active losses, active credits. On the income side, we have three buckets. So we have active, passive, and portfolio. So an individual subject to the passive loss rules, which has a passive credit that they have purchased, cannot use that credit against the tax liability from active or portfolio. So if I get dividend income, that's going to be portfolio income for me.
Got it. So portfolio income, dividends, capital gains, things like that. Bad income for purposes of tax credit transfers. Got it. So you mentioned earlier that the proposed regulations that came out in June said that just what we outlined, that these credits are really meant to are really subject, can only offset liability from passive income. But there was an article this week in Bloomberg Tax that was titled, quote, Treasury floats allowing individuals to buy energy tax credits. And Marc, you and I were both on a tax working group call organized by a accounting firm this week, and this caught a lot of people by surprise. Can you provide any context here?
Yeah, so the Bloomberg article, which I've not seen, I've heard about it. That Bloomberg article was referring to the ABA tax section meeting that's going on as we speak this week. In fact, it might be over right now. It was Monday through Friday, and we're speaking on a Friday. And on Monday, they had the energy subcommittee meeting. And there was a woman from Treasury on that call, two folks from Treasury. And questions were asked about the passive loss rules, about the provisions in the proposed regs. And the individual from Treasury said that they've received two buckets of comments. Some of the comments which use the argument from a policy standpoint that we need individuals in the marketplace, and if we didn't have to worry about the passive loss rules, we would have more capacity purchasers to purchase the credits that we're going to have out there. With we have 11 new credits through the Inflation Reduction Act, and so folks are anticipating that we're going to need a lot more purchasing power out there in the marketplace for all these projects. So there were quite a few. I was involved in drafting one of those comment letters with an individual that actually spoke at Treasury. And then there were a number of comment letters that focused on the legal issue, which I just described in the sense of it doesn't mention in the in the statute anything about the application of passive loss rules. And since it doesn't mention that, do we have an activity? If all I'm doing is purchasing tax credits, in order for the passive loss rules to apply, we have to have trade or business activity. So do you really have a trade or business activity if you're just an individual purchasing credits to use against your tax liability? And if we don't have an activity, then arguably you don't have to worry about the passive activity rules. But the IRS is deeming it to be an activity under these proposed regs. So those were the two buckets of comments. All they said is that they're reviewing the comments. It wasn't. In fact, one of the comments that they made is that their data didn't show that they needed the individuals in the marketplace to purchase the amount of tax credits that they think will be available. So I think that article is I like the title of the article, but I'm not as optimistic as some other folks obviously that were listening to the same session that I was listening to on Monday. So
got it. All right, let's move on. Individuals aren't the only group of taxpayers subject to the passive activity rules. Can you discuss the other groups?
Well, pretty much the rule is if so back in the 80s, what Congress did is they said, hey, listen, if you're a widely held C corporation, then you're not subject to the at-risk or the passive loss rules. So pretty much, if you're not a widely held C corporation, you should be thinking through the passive loss rules. And a widely held C corporation is a corporation that's not a closely held C corporation, and a closely held C corporation is a C corporation that has 5 or fewer shareholders owning more than 50% of the equity in the corporation. So if you're a widely held C corporation, which are the usual suspects that purchase tax credits on the tax equity market, they're all, for the most part, widely held C corporations. So, they may not even know what the 469 passive activity rules are because they don't technically have to worry about that. Nor do they have to worry about the at-risk rules, except in some special circumstances called inverted leases, but that's beyond the scope of what we're talking about. So generally, if you're not a widely held C corporation, you should become acquainted with these rules if you're thinking about purchasing tax credits.
Great. Now, to add another wrinkle, you have written in the past about an exemption to the passive activity rules that apply only to closely held C corps. Now, can you elaborate on this?
Sure. So as I mentioned, you got 3 buckets of income. So you've got your portfolio, your active, and your passive income. And then you've got these 2 buckets of credit/loss limitation rules, and that's passive and active. So there is a special exception in the passive rules, the passive activity rules, that apply to closely held C corporations that individuals don't get the same benefit for. And so if you're a closely held C corporation, let's just say you're an auto dealership, and you're an auto dealership, you're closely held, let's just say father and son own more than 50% of the auto dealership, and they both work in the auto dealership. That's another key thing, is you got to make sure that in order to get this exception, that you're five or fewer, at least that more than 50%, those folks are material participants in that business. And if they are, you're a closely held C corporation, if you go and purchase credits, you can use those credits against your active income or your passive income, but you can't use it against your portfolio income. So this has helped quite a few businesses that I've represented over the years that are closely held C corporations in being able to invest in tax equity deals.
And the same would apply to transfer transactions as well.
Correct. That is correct. So you would be able to, a closely held C corporation where you meet these material participant requirements with your five or fewer shareholders would be able to take advantage of this exception and use those credits against their active income.
And is the qualification all of the shareholders must be material participants, or is it a pro rata amount? So if 30%, you can take 30% of the credits, or is there?
So my recollection on this is that you have to get over that 50% threshold. So you'd look at the individuals, that get you over 50%. So let's just say you're 100%. You may not need all of them to be material participants, but you'd have to at least identify enough of the individuals that cross over the 50% threshold and make sure that they're material participants. And it has to be, if that C corporation is involved in multiple activities, but you're looking at the tax liability for one of those activities, you have to make sure that they're material participants in that activity. And the classic example of material participant is spending more than 500 hours in that activity. So
Great. Now, just going back to one of the things you said about closely held C corps who have this exemption can use passive credits against active and passive income. But let's talk about portfolio income, because there are a lot of banks that are closely held C corporations, and the character of their income is slightly different than a typical closely held C corporation, in that most of their income is interest income come off of loans, which is what we previously said was portfolio income, not active income. So would these banks that are closely held Cs not be able to benefit?
No, it's the rules say that even though you have this mortgage portfolio and you're getting interest income, that if you're in the active trader business of lending, then you can use the tax liability from that mortgage portfolio as active for this purpose. So for the purpose of using these credits to offset the credits against the tax liability from the interest from the mortgage portfolio. But you have to go look at those five or fewer individuals and make sure that they're active in the business of lending. So if the bank has multiple businesses, you have to just identify these individuals, make sure that they're active, they're material participants in the business of lending. So we've got some small banks that invest in tax credits, and they use this exception, and they're closely held C corporations. So
great. So Marc, are there any other requirements for a closely held C corporation to take advantage of this exemption? And are there specific best practices that you recommend that a closely held C corporation undertake when thinking about acquiring tax credits?
Well, I think the situation where this would be important is, when I mentioned you have five or fewer shareholders, when you have five or fewer shareholders owning more than 50% of this C corporation, I also mentioned that you have to pass this material participation test. And so if you've got shareholders that are engaged in other businesses, such as, you've got a lawyer and the lawyer has a full-time practice, but needs to justify that they've spent more than 500 hours in the mortgage lending business, they're going to want to keep track of their records of the time that they spend in this business in case of an audit. So it's really important to document, to keep a log of how much time each day that they spend in this business, and put down exactly what they're doing for the business. So that is super important and will help you if you're ever audited.
Great advice, Mark, and I think everyone should definitely take into heart, that carefully documenting, and making sure that you prepare for future inquiries or audits is very important and should be best practice in any of these transactions. So that wraps up our 10 questions with Marc Schultz. Marc, thank you very much for joining us today, and we look forward to talking to you again soon.
Thank you, Billy. Really appreciate it.